Have you been doing fix and flips already? Or are you a beginner or just thinking about it? Imagine if you could not only see and feel how successful flippers flip, but you would understand it so well that when you negotiate a property, you could go like,
This is BS and that is BS. Therefore, my price cannot be any higher than this. Period.
I do hard money loans, and from my experience, I will share with you what I see that successful flippers do consistently and what struggling flippers do not do, which is why they're struggling. How does fix and flip work? Well, you need to find a house that need repairs, right? So you buy this house and then you do the repairs, and at the end you have that shiny new big beautiful house, right? Now here's the problem. Banks do not finance houses that need repairs. Banks only finance move-in ready houses. So meaning that houses that do not need repairs. So, for this type of financing, you must go to the private sector, to what they call a hard money lender. Those are some lenders who will welcome you with open arms and they will finance exactly that type of purchase mixed with repairs. What is the difference between banks versus hard money lenders? Well, like said before, banks lend on the as is value, meaning on the current value of the house you're buying. It has to be in move in ready condition. Whereas hard money lenders, and we'll quote as HML, they lend on the future value of your house, meaning the ARV, the after rehab value. So you see, there's a lot more risk here that a hard money lender takes. And this is why you see a hard money lender loan is higher rate than the regular bank loan. You see, the HML lends on the asset, whereas the bank lends on the current house, the as is value. So the banks, what they care about is your ability to pay back. So this is why they care a lot about FICO, pay stubs, job stability. As an example, they will want to see if you've been in a job for more than 2 years, and also your DTI, your debt to income ratio. Whereas the HML, who bets on the ARV, the after resale value, they will care about the assets. They will care to see if the asset holds the future price that you see for that property that the market prescribes. So then they will certain things as well, like judgments, bankruptcy, because those affect the property, and also the FICO, the credit score, I mean, because they use the credit score to price the offer. So the better credit score, the better the offer will be. And as well, they will care to having a minimum FICO score just to make sure that your person who actually respects his or her promises. But when it comes to things like pay stubs and job stability, no, the hard money lenders do not care at all. Now, other things that will affect your offer as well are your experience. First, your experience is super important, meaning that a person who has 5 flips under their name will get a much better offer and a lot more offer than a person who has 0 under their name. Another thing is the amount of down payment. We will cover that a bit later in this video. If you like this content, subscribe and share with your community, please. And if you want a fix and flip offer, a loan offer, I put a 2-minute application link for you down below. Just apply and you'll get an offer, or call us. How do hard money lenders work? So let's say you find a house, right, that needs repair, and then you can do a good profit on it. You go to a hard money lender, right? The hard money lender, usually they will give you up to 90% of the purchase price of the house, meaning that we need to come up with a 10% down, plus they will fund 100% of your repairs. The way the repairs work is with a process, meaning that the money is not given to you upfront, it's held for you in escrow. So what happens is that every time you finish one part of the repair, we come and do an inspection, and then we pay you for the part of the repair that you finish. And now, about the down payment, usually it's between 80 to 90% of the purchase price, meaning that you have to come up with 10 to 20% of the down payment. And it depends on your experience, etc. But I know some hard lenders will give up to 90% to even a newbie. How does the math work in the eyes of a hard money lender or an HML? All right, so let's go to this graphic. Remember that HMLs, they lend on the future value of your house that you will be repairing. So the ARV, the after rehab value. So the value of that house is the value. We have to understand a concept called loan to value, meaning the amount of loan that you will get compared to the total value of your house at the end, right? So in general, hard money lenders, they will lend you up to, let's say, 75% of the loan to value, meaning 75% of the final value of your house. Therefore, there's a profit here. See, there's a 25% profit, right? Because you have 75% plus you'll make your profit. So you have a 25% profit. And this is where hard money lenders mitigate their risk. This is where the risk is. You see that 25% give the hard money lender a buffer to diminish their risk, right? The higher the profit, the higher that buffer, well, the less risky the deal is. And then you'll find other HML giving you 65% LTV, 70% LTV, etc. Let's take an example. Let's say your ARV, your future house, will be $100, right? So if it's $100, therefore the maximum that you can borrow is $75. 75% of $100, right? Therefore, the profit in that will be around $25. Let's take a real-time example. All right, this is an actual offer that was given to one of our clients, right? This is a loan for $300,000, right? The purchase amount is 220, and the rehab holdback, meaning that the draw that they keep for in escrow will be $80,000. Now note the ARV, right here is $400,000, right? And then you'll see like the down payment is 10% right here. However, very important, and this is why we are sharing this example, is that you will also have closing costs like origination fees and things like title, etc. So if you look at the closing costs in total, they're an extra almost 6%. So the closing costs in general, they're between like 4 to 6%. So the amount of money that you will have to come closing, the down payment, plus the other costs will be around 16%. This is very important to remember that those costs always exist no matter what, and they're famously known as closing costs. What type of flipper are you, or should you be? This is the important part to understand so you can create or change your vision. At the end of a flip, you have two options, right? You can either sell or rent. So after you purchase your house and you repair it, you either sell it or you rent it out. Now, the selling part is the obvious one, right? You just purchase a property, you repair it, and you sell it. And this is the one that most people tend to go after. Now, to understand that part better in the eye of successful flippers, because I fund those people. So I see what those people do that are different from what other flippers do not do. So let's look at it in the eyes of those people, right? Those successful flippers. To understand, let's go back to our previous graphic, right? So you have a hard money loan for 75% loan to value, and your profit on the property is around 25%, right? This is what the regular flipper, the average flipper, goes after. However, I see for the successful flippers, not the regular one, I mean, not the regular one, the successful flippers, they flip the script. For them, instead of looking for 75% loan to value, they go for 65% or lower so that they can have a profit that is 35% or higher. So that gives them a great cushion, great profit, and they can stay in business and make a lot of cash. So those people, what they do, they reverse engineer their buying process. So when they talk to their, let's say, real estate agent, they go first, hey, bro or girl, whichever, I need a property that where I can make at least a 35% profit on it. Therefore, I'm looking for a 65% LTV or lower. So when they go out there, they just do not go to look for properties, they'll go out to look for the right property. So again, it's not about finding a property, it's about finding the right property. And this is how you should look at it as well. Option number 2 after a flip, which is to rent the property, which is a rental. So basically, after you bought your house and you repaired it, then you go and rent it. In order to do that, you have to refinance, meaning that you had what they call a bridge loan before in order to get the financing for the repairs. This is a short term loan called a bridge loan just to accommodate you doing your repairs, etc. But once the house is done, now you need to refinance it into a long term mortgage so that you can have low mortgage payment over a very long time at a good interest rate. Therefore, when once you rent it, you can make a little bit money on it, you know? A rental long-term mortgage is called a DSCR loan, debt service coverage ratio. And it's usually for 30 years, either fixed rate or 7-1 arm, whichever. This is a bunch of jargon, but the goal is that it is long term for cheap and at a good interest rate. Now, when you rent out the property, all right, the goal is to have a net cash flow of zero, meaning that you're just looking to cover the cost of your mortgage from the rental income that you get. So basically, if you can get a rental income and then when you subtract your mortgage payment and it's zero, meaning that you make $0 profit every month on the property when you first start, it is a good deal. It sounds bad, but trust me, it is a good deal, and I will prove it to you. Very important. You have to remember to factor in the cost of maintenance and vacancy, meaning for the month that the apartment will not be rented, right? Super important, and that's obvious. So at the end of that, at the end of the year, let's say, if your net cash flow equals zero, that is a good deal. Remember that renting is a long term game. Actually, investors make this mistake. They see, oh, if I rent it, I will make no money. Actually, that's wrong. You need to look at it at the long term. You see, first, once you rent a property, even if you're not making money on it, well, the next year there will be rent increase every year, each year, without missing one. So right there, you will start making a little bit of money, but this is not how to look at it. Number 2, your property will increase in value over time. And this is a proven thing. We can look at the chart of how the median price increase has evolved in the US over time. So each year you have an asset that increases in value. So you bought it, let's say, at $100. Well, a few years later, it will be at 120. Third, each mortgage payment that you do, that other person pays for you actually, goes toward your principal. So what happens is that your equity in the house increases after each payment made. So over time, you will have a lot of equity in that house, right? And fourth, the tax write-off, because the interest rate that you pay on a mortgage actually are tax deductible. Whereas if you just flip it to resale, well, you have no tax write-off right there. So that is a huge advantage over time as well. Let's look at the median house price in the US over the last few years. So this line in blue is the house price, and the one in red is the median household income. So if you see how the house price outpaced the median household income, it's pretty crazy actually. So if you did a fix and flip back in 1985 and you decided to rent out that house, today that house would be worth around $440,000. And at this point, it would be paid off already by someone else, the person you rented it out to, and your asset will be worth $440,000 and going up. So this is pretty incredible. This is how you have to view the rental part of a flip. It's a long-term piece. Whereas if you sold that house in 1985, yes, you would have made some income, but after that, what? So it's two very different beasts. Flipping to sell is very different from flipping to rent. One is short term, the other one is long term. Why is now the time to start on a fix and flip? Well, 10 years ago, if you had no experience, you were just starting, it was really tough to find a lender who would lend you. However, today, things have changed a lot. There's a lot more lenders today who would give an unexperienced flipper a hard money loan. Second, a lot of beginners, they are trying to find the perfect market, the proper time to invest. Listen, remember in 2008? 2008 was a time where the real estate market switched drastically overnight. I think the kill switch was the bankruptcy of Lehman Brothers. So suddenly you had a seller's market, and then when that happened, suddenly you had a buyer's market, and the prices were dropping so much that people were afraid to buy. However, some people bought and they made an absolute killing. So what I'm saying, what the successful flippers are saying is that the market is always right. You need to time it and change your strategy about that. But there's no perfect time to start, or you will never find that time. Finally, I put another video here for you that will explain to you how to 100% finance your fix and flip. Check it out. Peace.